mortgage markets, and more. I'm your host, Peter D'Angelo. Welcome to Monday, everyone. I hope you all had a wonderful weekend and enjoyed your St. Patrick's Day appropriately. I have your mortgage rate update today, as well as a little bit of an educational component. I know we talked about mortgage insurance in the past. We talked about appraisals on a real estate episode. Today, we're going to conquer debt to income. We're going to explain that a little bit. First and foremost, let's get down to the rates. Good news last week, not so good news this week. We had some data that came out that showed the producer price index was higher than expectation. It's, for our purposes, it is just another measure of data that's in the economy that lets us know about how the prices of things are for which will eventually trickle down to the American consumer. And that came in hotter, which is paving the way for maybe what we could see in future reports for March being higher inflation possible in the future. The markets, which dictate and create the interest rate environment, reacted negatively. So here's where we've got our mortgage rates. The 30-year fixed rate mortgage week ending last week was at 7.09%. We crossed the threshold. Again, this is from the Mortgage News Daily survey of mortgage rates as of Friday last week. The 30-year FHA rate was at 6.6% on average. The 30-year VA for veterans, that was at 6.62%. The 30-year jumbo ticked up to 7.38%. That's for loans that are above a certain size in certain markets. And it varies across the country what qualifies as a jumbo loan. So that's still a more expensive loan product as we've been seeing over the past few weeks. And the 15-year fixed rate mortgage was at 6.6%. And that adjustable rate mortgage we were talking about for the past couple of weeks was at 6.78%. We talk about the 10-year Treasury bond being a rather good indicator for mortgage interest rates. They do move together particularly closely. The 10-year Treasury was at 4.304% on Friday. And when we rewound the clock back to March 7th, that was at 4.09%. So from 4.09, we got up to 4.3, and you can tell the difference there, and you can see the difference in the 30-year mortgage rate, which is sitting now again squarely in the middle of the 52-week average of where we've seen rates. So not good news, not bad news. We're dead center on what the average rate has been for the past 52 weeks, the past year. Moving along from where the interest rates are, let's talk about debt to income. Debt to income, another acronym for you, DTI. Debt to income is something that's an extremely important component to qualification. Essentially, debt to income compares the gross monthly income of a prospective borrower to the proposed payment of the property, inclusive of their debts as well, everything that's reported on their credit report. This isn't their credit score. This is taking a look at the monthly obligation factor of the liabilities that a borrower has to make payment on monthly. This is revolving credit card debt, personal loans, student loans, anything that is a monthly obligation reporting on credit. That gets included in the debt to income. We look at what the gross monthly income is. So it actually doesn't go based upon what your net income is after taxes. It goes based on your gross. We have to ensure that the debt to income ratio, which is expressed as a percentage, is within the guideline for whatever loan program you're in. I particularly use whatever the debt to income ratio is that's appropriate for a client's monthly payment and their monthly payment budget. And then that will dictate to me which loan program will be the most beneficial to the client, because different loan programs have different requirements. I'm not going to get into the particular requirements of each loan program, but suffice it to say, we do have different availability and leeway on the debt to income, the DTI, based on the different program that you could be trying to apply for. And that's what my job is to find the right program that fits the qualification. How do we derive that gross monthly income? Well, we verify it. We verify the gross monthly income by way of your pay stubs, taking a look at your W-2 to ensure that. And then at Guaranteed Rate, we have the benefit of a pretty awesome system that in some cases, and actually at this point I could say more often than not, I'm able to get automated verified income that I know to the penny how much I get to use as the qualifying income for a borrower based on what's reported on that automated income verification. Then we take a look at a possible property. I always like to use a scenario. So when working with a client, I find out, oh, where are you looking to buy? They tell me the market that they're looking to buy in. And then I find a property that's listed for sale and use that as a case study. I say, okay, well, given the amount of money that you're interested in putting as down payment, you have a minimum down payment requirement of X amount. This property falls within that range, and we will include the monthly portion of taxes, a monthly portion of homeowners insurance, and then if you put less down, as we talked about before, there could be mortgage insurance. All of these things get accounted for in including the principal and interest payment for the loan, and we take a look at that compared to the gross monthly income. If that falls within the guidelines and falls within the proper range for the DTI, then you are now pre-approved, and I can confirm that for you after taking a look at your credit and making sure that I have all liabilities accounted for. Other liabilities that need to be included in the debt to income ratio that may not be on credit are things like alimony and child support. If a client is divorced and they are obligated on child support or alimony, we need to include that liability in the DTI. Conversely, if you are the recipient of alimony, child support, after we have a certain amount of time showing that you are receiving it monthly, paired with the divorce decree that confirms the amount that is going to be paid to you monthly, we get to use that as part of your qualifying income. So it works on both sides. There's also maintenance and there's other things that could be included in the debt to income ratio, but suffice it to say, these are the basics of what we look at. And then that ratio will dictate to us which loan program is going to be best for you and which one you'd be qualified to use. There are two ratios. There's not just one, there's two. One that's the front end DTI, one that's the back end DTI. The front end DTI compares your gross monthly income to exclusively the proposed mortgage payment. So front end, think about you're going in the front door. You're only worried about the house. You're going in the front door. Front end DTI is comparing gross monthly income to just the monthly payment. Principal, interest, taxes, insurance, and possibly, if you're putting less than 20% down, mortgage insurance. Also, if you have flood insurance required, just a quick note, that's also included in the debt to income ratio. It's part of the carrying cost of the property. Then there's the back end ratio. Think about everything gets dumped in the back, right? We're just dumping everything in the backyard and for purposes of this illustration. And that is your gross monthly income compared to the proposed debt of the property you're looking to buy, as well as all of the liabilities that are accounted for on your credit, as well as if you have alimony, child support, things like that. So that back end ratio is typically higher. We need to make sure both of those ratios are within a certain margin for qualification to work. And that's part of what we do in the pre-approval process to confirm. Now, if you're managing your financial situation prudently, normally you're setting a realistic budget for yourself for a monthly payment. And so then normally things align, and they will align in a way that would typically work. So you know how much you're willing to spend monthly based on what it feels like compared to what your current rent is. Or if you're not renting, knowing how much money you've been able to save by not renting every month and what would be appropriate for your monthly payment. So the debt to income ratio is right up there. Down payment, credit, debt to income. These are some of the most important factors to your pre-approval. Other things that will affect your debt to income ratio are things like if you're a self-employed borrower. There's a different calculus in how we do that based upon different programs. We have a number of different programs for self-employed borrowers, but speaking to the conventional guidelines, that's more of an averaging that we do based upon a 2-year history of the income, by and large. There are some other guidelines that permit just using the most recent year's tax returns. And as they stand currently, as I'm recording this, you need to be self-employed for 5 years or more in order to have access to that type of underwriting approach. Underwriting, for purposes of explanation, Underwriting is the process in which your loan application gets reviewed and a decision is made on the approval of that application. That's the underwriting process. And the person who wears that hat, who's called an underwriter, they are the one who's in charge of making that credit decision. They take a look at all the things like your credit score, your down payment, any reserve assets that you may have, as well as what your debt to income ratio is. Moving on from there, if you own property, depending on how you're claiming your income for those properties, and there's too many scenarios to get into right now, but if you own property that you own could affect your debt to income ratio positively or negatively. That will depend on how that is being claimed on your taxes first and foremost. However, there are guidelines that permit you to use income from a rental property if it was, let's say, a converted property that you lived in and now you're leaving, and you can use, in some scenarios, the expected rental income provided that you have a lease for the new tenant that will be occupying that property that you're vacating, or if you had family that was living in a property that maybe wasn't paying rent, then you get a tenant in that property. There are some guidelines that will permit you to use that rental income as part of your qualifying income, which will certainly affect your debt to income ratio. That's it for me today. I hope you found this information useful and helpful. I will have another real estate market update for you on Friday before we have our next installment of the National Association of Realtors existing home sales data, which will be reported at the end of the month. Until then, I hope you have an awesome week. Make it a great week, and I look forward to talking with you all on Friday. Take good care.